Welcome back to another episode of the Mogul Marathon Real Estate Podcast. I'm your host, Yannick Cudjoe-Virgil. I'm super excited for our guest today. We have an amazing woman, Davonne Reaves. Davonne is an award-winning hotel consultant, asset manager, and the owner of 3 hotels. She is the founder of Vesterr, the first crowdfunding platform for hotel investments, and the Vonne Group, a company she created to teach people how to become successful hotel owners. After starting as a front desk agent in the hotel industry 15 years ago, Reeves Davonne held various positions, including in asset management, where she managed portfolios totaling over 1 billion in hotel assets. And today she has educated over 4,000 people and provided a path to hotel ownership to many individuals across the US. When Davonne first acquired her first hotel under a major hotel chain at 34, along with her partner, they became the youngest Black woman to do it in history. Davonne, thank you so much for being on the show today.
Thank you, Yannick. Thank you for having me.
So I'm really excited because we met on Clubhouse a couple of
Right.
years ago, like when Clubhouse was just
Stop.
crazy. We had those marathons. And I can't fathom just like being on Clubhouse today and just spending like over 12 hours on it.
Well, everybody's back out in the streets now, so it's different. Back then, Clubhouse was popping because we were all in the house, so it was
Yeah.
cool, But
Yeah. No, I can't spend too much time on Clubhouse, but give our listeners today some insight on who you are and how you got to where you are today.
well, you said a lot in my bias. I appreciate that. Sometimes I get reminded. I'm like, well, I did all this stuff. But yes, I did get my start off as a front desk agent. I navigated my way through hotel ownership by taking a non-paid internship at a consulting firm, and that's where I learned about hotel ownership. Who better to learn from were other hotel owners, because they were our clients. And so I was there for about 3 months, and then I went on full time 2 years, and I moved to Boston, worked for a larger firm. And again, that's where I managed, had a over or help overseeing a portfolio of like $1 billion, which was like, wow. Again, understanding P&Ls and financials, how to put deals together, really understanding how sophisticated and complex deals or complicated deals are put together. So that was cool to understand. And then in 2017, that's when I started the Vonne Group, which is a consulting firm and investment firm. And in 2020, we acquired the Home 2 Suites with Nassau Investments. And in 2021, last year, acquired 2 more properties in Indiana with Nassau Investments. So shout out to Mike Ely. We have a Hampton Inn and Suites in Scottsburg, Indiana, and Staybridge Inn and Suites in Indianapolis Fishers. And then most recently, I just launched a crowdfunding platform, Vesterr, which is not only just for hotels, but it's for other commercial real estate asset classes as well. So you have, multifamily, daycare, senior living. And I designed that because I saw there was a need. There were folks who were like, hey, I have this deal, but I need the capital. And then I was meeting people like, hey, I want to invest, but I don't know where to go. So I saw that there was a need, a problem, and so I created a solution.
That's amazing. So I want to take it back to the beginning of the days. You said that you took an opportunity where you essentially worked for free.
Yeah.
Right? Like how important was that? Because a lot of people, when they get into the commercial space, they want the big money now, right? They might have had, success in the residential space and they want to just turn it up in the commercial real estate space. But you took a sort of a different route, right? You wanted to learn before you earned. How important was that to your success today?
That's right. I like that. I may sue that. I wanted to learn before I could earn. You know what? That's right. Well, in order for me, so I had a goal in mind, right? So I was like, okay, I knew that I wanted to get into hotel ownership or the transactional side. And I was like, okay, what can I do to get there? I didn't go to school for real estate, finance, and economics. And so the job opportunities that were out there for me to get into asset management or feasibility studies or really get onto the transactional side of hotels, you had to have that in your background or in your experience. And I didn't have it. So that was hindering me from getting the job opportunities that I need. And so when an opportunity came with that non-paid internship, I took it. And guess what? That they turned me down.
Hmm. Why is
Right.
that?
I got turned down. Well, they didn't understand why, because I already graduated from college, so they didn't understand why I would want to take a non-paid internship. Like, so they were just like, no, this is. I'm
She's
like,
up. She's up to something. Clearly.
what? They didn't. It didn't make any sense. I was like, how do you turn me down? Like, it's free. Like, you need the clearly you need the workers, right? And so I'm a little persistent. And being in football, you understand, being persistent, being disciplined, and being competitive. And basically not taking no for an answer, right? And so I was very persistent in making sure that I get the job, because I'm like this. I knew that non-paid internship as an analyst working in this space would help me get to where I knew once they hired me, they were gonna keep me. I knew it. I was like, I'm gonna work my butt off. They're gonna fall in love with me. They're gonna keep me, and I knew it. And that's exactly what happened. And that was the best decision I could have ever made, because that helped, that catapulted me. And the biggest thing was it was able to bring experience to my resume, because I learned about the transactional side of hotels.
Yeah, and you also learn on someone else's dime, right? Before you
Yeah, that's true.
incurred costs on your own, because these
That's true.
deals cost a lot of money and it
They do.
requires a lot of liquidity. And
They
it's
do.
always good to and I don't want to say fail, because you're obviously a fiduciary for who you work for, but
Right.
it's much better when you get to learn on someone else's dime. And so
Right.
that's exactly what I did too in
Yeah.
my journey from football to commercial real estate. Was I went and I took a job for a couple of private equity firms, and I
Mm-hmm.
learned from people who were cutting those checks, right?
Mm-hmm.
Being in those meetings, knowing
Right.
how to handle the same situations that you likely handle today in your own business. There's just a ton of value
Yeah.
from learning on someone else's dime.
Yeah. Exactly. And of course, they didn't think that I was. Nobody thought that I was going to. I didn't tell them, but they didn't think that I was going to. I'm sure get to where I am, right? Or they didn't probably even think I was paying attention. But I definitely use that as my advantage. I always had it in the back of my mind. A lot of people didn't even agree with me, taking a non-paid internship. It was like, Davonne, like, it doesn't make any sense. And I had to work at the non-paid internship in the morning, and I had to work at the Hyatt at night because I had to pay my bills. But when you hungry for something, you got to have that hustle in you, right? Nobody, I think a lot of times, especially now, I'm seeing a lot on Instagram, people want things to be given to them, and nothing is given to you. Like, you have to work for it. To your point, you have to earn it. Right. And so in order for me to get to my goal, I knew of hotel ownership, I knew I had to earn it. I had to figure it out, and I had to be creative, and I had to create, something out of nothing, basically.
Yeah, yeah, and especially in the world of real estate private equity, is nothing nothing is given to you
Nothing is
in
given.
this
And
space.
especially in private equity. Oh, you got to work. Like, you got to figure it out, and you got to be creative. And and if it's a no, that means that the deal is just not supposed to happen. But if it's a good deal and you need to get to the closing table, you need to figure it out.
Yeah.
Yeah.
So let's jump right into it. Why hotel investing? There's a lot of content out there about multifamily or some other investment types, but there doesn't seem to be much, to my knowledge, spreading around social media about hotel investing.
Everything's
We've
for me,
seen
right?
we've seen during the pandemic, occupancy rates tumbled. Things
Right.
have rebounded since we have opened up the economy.
Right.
I want to get your take on why hotel investing.
So why hotel investing for me? Because that's all I knew. I started out as the front desk, right? Multifamily wasn't talked about in my family. I didn't know anything about it. I just knew. I didn't even know you could own an apartment building. I just knew it was an apartment building. Like, I didn't know individuals could own it. I didn't know individuals could own a hotel. Like, I just didn't know. Like, that just. So once I realized that you could own a hotel, I was like, okay, well, let me figure this out. Like, I didn't know anything besides hotels. Now since I understand that you can literally buy anything, because anything is for sale, like, everything has some type of transactional or dollar amount associated with. um I knew, okay, this is, I'm starting to see outside of hotels. But this is just what I became an expert in, right? This has just been my field of study. And I'm looking to dabble and to diversify my portfolio with multifamilies. Hotels is probably one of the most complicated assets out there in commercial real estate. So for me to dibble into other asset classes will probably be a little bit more easier, because I understand the fundamentals. And once you start to understand the fundamentals, a lot of other things kind of make sense. It's like, oh, okay, because a hotel is an operating business sitting on assets sitting on real estate. In multifamily, it has like the rent roll and you got your expenses and you got the staffing model. So it's a little different and not as complicated.
Yeah, and again, there's hotel investing is something that is requires to at least how I look at it, right? I've never invested in a hotel, but a
Not yet.
specific niche, right? Because I want to get into the KPIs and stuff
Mhm.
next, but it seems like an investment strategy that requires for you to be you need to be in the industry, it seems like, to know about investing in a hotel, or how does someone learn how to
Right.
invest in hotels?
So a lot of people, actually, a lot of the owners, they're not in the hotel business. It's just something that they want to diversify they portfolio. They had some additional cash, so they just happen to get into it. A lot of hotel owners never even worked in a hotel. It's probably why a
Mm,
lot of hotels are the way they are now, because they never worked in it, right?
yeah.
So you don't necessarily have to have the hotel experience. What you do need to have, to be a sophisticated hotel owner, or to really have a growing portfolio, probably really understand real estate, understand the fundamentals of real estate, being capitalized. And if any smart investor knows what to do, they know how to build teams. So even if they're not an expert in hotels, they're like, okay, let me just go ahead and pay this consultant or pay this management company to run it and operate it. And that way I can focus on my other stuff.
Yeah, that makes total sense. This business is all about teams. You can
Yeah.
choose to be active and run the day to day, and if you want to be a professional hotel, owner operator, and manage everything soup to nuts, that can be great. But you can also actively invest in them, but also have someone else run it for you,
Right. Yeah.
and be the asset manager, and leverage their expertise to be successful in this space. So let me ask you a question. When we talk about recession resistant assets, is this considered to be a recession resistant asset to you? Like, how are you de-risking yourself? Because I understand that the pandemic was, a black swan event, and no one expected COVID to be as, how it came out to be. But are hotel investments considered to be recession resistant? And how are you de-risking these opportunities?
Um, so it depends. You may actually hear me say that a lot because it depends on the type of hotel, right? So if you notice during COVID, even though a lot of people may not personally been traveled as much, like corporate, because the hospitality industry is cyclical. And it's if the economy is doing well, travel is strong. If the economy is not doing well, then travel is not strong. But one thing that remains consistent and maybe a little dip, people truck drivers still need a place to stay. Remember during COVID, all the merchandise and items, I mean, we couldn't get in fast enough, and the truck drivers are doing the best that they can to, move the merchandise. But guess what? They're gonna need a place to stay. Sometimes they don't want to stay in a truck, right? They want to. So those type of hotels are typically economy, limited service, extended stay hotels. So those hotels probably of any of the sectors. And so for those who don't know what economy, limited service, so economy hotel is hotel with very minimal amenities, no food and beverage, meaning no restaurant. So something like a Super 8. So that would be considered an economy hotel. A limited or a select service would be something like a Hampton Inn, right? It's a little bit above, step above the economy, but it still doesn't have like a food and beverage outlet. So meaning you can't have breakfast, lunch, and dinner. And then you have what you call a full service hotel, which has your breakfast, lunch, and dinner, maybe even a spa. So those the full service luxury, those type of hotels probably didn't do perform as well, depending on which market you was in, because people weren't traveling, especially the corporate travel. And another hotel sector that actually performed well was the extended stay sector. And for extended stay, for those who don't know, that's the hotels like with the kitchenette. So I have two hotels in my portfolio. That's an extended stay, which is the Home Two Suites and the Stay Bridge Inn and Suites. So it has a kitchenette. So literally, you could stay in the hotel for like a month. It has an oversized refrigerator. It has a stove, microwave, suite, sleeping area. Those hotels perform well because it's a lean labor model. And also, typically people say, at least 7 days, 5 to 7 days, right? So, meaning they're not getting the housekeeping service that they normally would. So, probably out of those hotels that I mentioned, extended stay, select, extended or economy, those particular, I wouldn't necessarily call them full blown recession proof, but those are the type of hotels that I would have in my portfolio to kind of help mitigate the risk during a recession or economic downturn.
Yeah, no, that makes total sense, especially when we take a look at it from a expense perspective. You definitely want to manage your costs when things are down.
Yeah.
So I can totally see in the luxury space where you have a ton of amenities and staff that you have to pay to keep up with these amenities. You know, those types of hotels would be much more expensive to operate
Yeah.
during tough times, as opposed to extended stay hotels where you have people who might move towards more affordable lodging, or overall investment where that has less demand for amenities in that type of situation.
Right, exactly.
That's great. So how are you evaluating hotel opportunities from a top down approach? You know, if someone is interested in buying a hotel, I heard you on a different podcast talk about three KPIs that you look at, which is occupancy, average daily rate, and this thing called RevPAR. Can you break that down a little bit more in detail so our listeners can really dive in and pay attention to some of these metrics, so they'd be successful in their hotel opportunities?
Sure, absolutely. And you have a great memory. So yes, the three KPIs that you mentioned, for those who don't know what KPI stands for, that's key performance indicator, and that's basically a metric that is used to kind of get a better understanding of the hotel's performance. And so occupancy is just a percentage of rooms that are actually occupied by guests. So give you an example, if there's 100 rooms in a hotel and there's a 50% occupancy rate, that means that 50 rooms are occupied, like half of the room is occupied, half of the hotel is occupied, the other half is empty. So that's not give you an idea. Average daily rate is just essentially all of the rates combined, and it's an average of it, right? Kind of based off the room revenue. But AAA, Expedia, all of those different rates is kind of like give you an average of it. All like, ARP, all those different rates. And then you have what is called RevPAR, which stands for revenue per available room. And what that does, that gives it a indicator of how healthy the hotel is performing. So that's a calculation of the occupancy and ADR. And so you'll use that metric to benchmark and just kind of see, and going back to RevPAR, which stands for revenue per available room. So that means that if it's a 100 per available room, it's like $100 or something like that, which is going, and that's something that owners look at, or when you're evaluating, look at to see how much of that is going to flow down to the bottom line. So those are the things. So I get the question a lot, well, how do you evaluate a hotel compared to a multifamily? That's what you're going to be looking at, because it's going to have the rates and it's going to have the occupancies. Hotels, they're based off of nightly leases. Multifamily, you're based off they're longer leases. So you're kind of looking at the rent roll. So if you're looking like, okay, if somebody is staying in this hotel, staying in this hotel on January 1st, December 31st, the rate is like $500 a night, but in January 1st is like 99. Right. So you can fluctuate the rates. That's why a lot of times people like this as a sexy investment opportunity. But as a multifamily, it's the same, rate for like 12 months because they're in the lease. So that's some of the things that you look at when evaluating. Also, you want to look at the percentages, profit margins, cap rate. Hotels are typically 6 to 10, probably 7 to 10. From a cap rate perspective. Another thing that you want to look at is the NOI, which stands for net operating income. So how much of that revenue was coming down to the bottom line. Another thing you want to look at is debt service. Seeing when you're evaluating the hotel, seeing after you evaluated to see how much money is coming in after debt service, will that make sense for you? So before you start evaluating and this is just for any type of investment property, you need to understand what your investment criteria. So you may say, I'm okay with the 10% return. So when you're looking at deals, as long as it's at 10%, you good. You may say, hey, I need 20%. That's what I need for me to make some money and for me to pay back my investors. So when you're evaluating deals, okay, this is bringing a 20% return. Maybe you're looking at a targeted cash on cash of like 15%. So those are the things, but you have to know what works best for you, because percentages are percentages, right? So if you're like, okay, I'm looking at profit margins that need to be like 30 to 40%. So basically what that means from a profit margin standpoint, if you have, I don't know, I'm just making this up, $1 million in revenue for the year. And when you're looking at deals, you're like, okay, I need 40% profit margin. So what that means is that 40% of the revenue is coming down to the bottom line, right? So those are kind of the things that you want to look at, and those are the things that I look at. I'm not the best valuator. I'm more like surface level, and I can eyeball it like, okay, this is good or not good, and then I can like get it over to an analyst who's better. See, I'm good at building teams, who's better at analyzing deals than I am, to see if to see if my gut, if it makes sense, and then they look and see if the numbers actually base what my gut is feeling.
It's a great way to break it down from a top down approach. So on the topic of the RevPAR, would you consider that to be something similar to like a gross potential rent on a multifamily side of things? Is that a good application? So if you have gross potential rent of say
No.
$1,000 for one unit, but you're not collecting it essentially. Do you think that's like a similar evaluation, or
No. Mm-mm.
what do you like? How is RevPAR like looked at from a potential perspective if you're looking at a hotel opportunity? I really want to break that down because I've heard that that's one of the more important indicators when you're looking at a hotel opportunity.
Yeah. So the gross potential, and again, I'm not an expert in multifamily evaluating but what I'm hearing is like, okay, if let's say I buy this multifamily and I'm getting $100 a month, but after I renovate it, then now I can get probably $200 a month. Is that what you're saying?
Yeah. Yes.
Okay.
Yep.
You can project RevPAR based off the historical performance, right? So let's say you look at how the hotel is performing, how it previously performed, how it's performing now. So let's say the hotel has $100 RevPAR, and that means the combination of occupancy and the ADR is now at $100. Excuse me. Really, what is just saying is just what RevPAR is really just indicating how the hotel is performing as a combination of the occupancy rates and the average daily rate. So how you can look at it from potential, if I'm evaluating a hotel, then you look at from how the historical hotel actually performed. So, and then also you look at the market too. So it's two sides when you're evaluating a hotel. It's the market side and the financial side. So the market side is what are the similar hotels are doing and how are they performing in your market. So let's say your hotel is averaging $100 RevPAR, right, for the year. Okay. But your market, when you look at your comp set, they're already averaging like $90 a year in RevPAR. This means that you're leading the market. There means it's really not that much more room to grow. So depending on your strategy, you may not necessarily buy that hotel because you may want to come in as a value add opportunity. And that scenario that I just gave you is just not really a value add because there's not room to grow because it's based off the market. So
Yeah.
RevPAR, occupancy, ADR, that kind of gives you an idea of how your hotel is performing. So you can use it as a metric to benchmark against other hotels. So you can test your competitiveness. If
Yeah.
that makes sense.
No, that makes total sense. And how are you, if someone is trying to evaluate a hotel opportunity and look at comps, are you looking at, do you have like a software that you use to find other comps in the market to compare an acquisition compared to
Uh,
other surrounding properties, or is this
yeah.
public like information like a Expedia or something like that?
Nah, not really. You do have to pay if you want real comps. There's called what you call a star report with Smith or ST. Okay, so let me say this: in the hotel world, STR stands for Smith Travel Research. I know some people call it short term rental, so I'll be like, wait, what? So let me clarify that. So it's called what you call a Smith Travel Research, and so essentially what that is, it's a report, and it talks about all the different comps in your and you get that if you're acquiring a hotel, you're getting that from the previous owner or the current owner or the broker, right? And so basically what it's saying, so let's say my home two suite, for example, it's going to give me the hotels that are in my comp set or competitive set. That means like hotels. So if my hotel is in El Reno, then it's going to give hotels in similar hotels in the El Reno market, because that's because we're targeting the same guests. I'm
Yeah.
not going to get a report for guests that are visiting Oklahoma City. Even it's a
Right.
home two suites, the same size, but it's in Oklahoma City. Those are two completely different guests, because that person that's traveling to Oklahoma City, they're traveling to Oklahoma City. They're not traveling to El Reno. So I'm not going to base my comp or my research to see how I can predict the market based off of Oklahoma City. So I have to go by what is called an STR report, and it gives you that data. Now,
Yep.
it won't tell you, okay, hotel A ADR is A, hotel B ADR is this. It won't, you won't be able to kind of tell which hotel is which. We'll kind of give you like a blend, like, okay, this is how the market is performing. You can sometimes you can like call them like the hotel and you can ask. Sometimes they tell them, sometimes they don't.
Yeah, like secret shopping is what we do. We go
Yeah,
and fake act like we're a tenant and try to get some
yeah. So
information.
it's like that's what I'm saying. So sometimes they tell you, sometimes they don't. But a lot of times you just get the information from the STR report to kind of give you an idea of how the market is performing and how the hotel is comparing against the comp set. So let's say you buy a hotel and the hotel is like number 6 in the comp set. So let's say the hotel is the average daily rate for the hotel is like $100, but the market is 150. So that means that you probably, so then you look at that particular hotel and you're like, okay, do I need to renovate it? Do I need to change the flag? What can I do? Because clearly the market can support the 150. So what do I need to do to this particular hotel to increase the rate so that way I can get to 150? So now I just gave you a value add opportunity. Does that make
Yeah,
sense? How people have
absolutely.
their strategy? Okay. Yeah.
Yeah, yeah, no, absolutely, absolutely. That makes perfect sense.
Yeah.
Um, it's all about finding, and I'm sure those value add opportunities. Is that your criteria is looking at value add, or is it more kind of stabilized and maybe just cutting some
Probably
trim
more
off
so
off
value
the
add.
expenses?
Yeah, yeah, value add coming in. So coming in and so existing properties, I like to look at deals that have a management company, because how my life is set up right now, I can't really come in and check in and out guests. Uh I mean, if I have to, because they my hotels, I guess that's what I gotta do, but I prefer not to do that. So my criteria is really just buying properties that can support a management company. um yeah, so
Yeah,
that's my criteria.
no,
Value
that makes
add.
sense.
Now value add could be, it can be a branded hotel, but it's a mom and pop operation, meaning it's an owner operated model, meaning they don't have a management company, so they don't have the resources that a corporate or above property company would have. So that could be a value add opportunity. So the hotel in El Reno was a value add opportunity. Even though it was a fairly new hotel, it was still a value add because we came in and we brought a management company and helped stabilize
Yeah,
the we
yeah,
brought in
yeah,
a sales department, we brought in a different revenue management strategy. So we're like the rate lead, you know what I mean? So all of these
yeah.
different things that help, so that can be considered a value add opportunity.
Yeah, no, absolutely.
Yeah,
Absolutely. There's certainly value add opportunities where it's an operational play,
right.
for you, like you said, to bring in a management company, maybe a mom and pop operator who was just running it into the ground and didn't really have the sophistication
Right.
to take advantage of the market. So I
Exactly.
totally get that strategy. So
Yeah.
what are some expenses that you look at when looking at some of these opportunities? I'm sure that you have increase like cleaning costs and things like that. But how do you kind of eyeball on the
Labor.
expense line items?
Labor is probably the biggest thing that you want to look at. I'm a little different when it comes to labor because I used to be a line employee, so I'm sensitive. Some people, they've never worked in a hotel, they've never been a line employee, like they've had a certain type of lifestyle their entire life. So them crossing out an employee, they're not crossing out a employee, they're crossing out a number. Like
Yeah,
that person is like a number. Like to me, it's like this is a person who has a
yeah,
family, who has a lot, like that was me. So I look at things a little differently. So you do want to be careful about labor, but you don't want it. So it has to be a delicate balance. But labor is the biggest cost in a hotel.
yeah. Oh,
Um, Yeah, that's the biggest cost. So that's why models like extended stay, economy, limited service, the labor is not as high because you don't have so many different outlets and components. So the labor is not as high. So that's going back to my criteria. That's some of the things that I look at, which be a limited or economy service hotel.
That's a great point there.
Yeah,
So on the discrepancy of cap rates, like you mentioned, between 6 to 10% is I think is what you mentioned. Is
yeah,
there is do you see a variation in the cap rates and yields, or return on investment when you invest in a property like a Marriott versus a Choice Hotel or extended stay?
yeah, yeah. Definitely, and really more so market driven too. Market driven, and then the hotel type. So, a cap rate in New York would be different from a cap rate in America, Georgia, right?
Yeah.
Because it's a different type of hotel. The NOI is, significantly higher in New York than it would be in a tertiary market, right? Or New York City or something like that. So definitely, the cap rates would differ based on the hotel type in the market.
And what about leverage as well? Are you seeing like you get a higher leverage for maybe a Marriott type deal and maybe a lower leverage for like a Choice Hotel or extended stay? How are the leverages? Because in my space, say like if we're looking at a top tier market where like a New York, we might get a 80% leverage versus like a tertiary smaller market, the lender might be willing to do like a 65% leverage. Are you seeing that in your space as well when looking at these opportunities?
So it depends on the type of hotel, and it also depends on the owner, right, or the buyer. So some buyers, they want to do 65% leverage. They're in that space to do it. Some first time hotel owners, they can't afford to do it, so they come in at the 10 to 20%, putting out equity, so they're at 80% leverage. Um, some brands, like some hotel types, you can start off with like the 10 to 20%. And also really depends on the lender too. Like a lot of times if it's a development deal, the lender probably wants you to come in at 50% to put down. Uh Depending on the relationship so it really boils down. That question is really based off the lender and buyer and how their respective situation is. The type of hotel. So so if it's more like of a full service hotel, that's a different type of investor. So they're coming probably from like a 65% leverage standpoint, as opposed to an economy hotel and it's the first deal. They're probably, because they're just trying to get their feet wet. So they're at 10 to
Yeah.
20%. Yeah.
Yeah. Okay. No, that's a interesting because I think it's when I think of I had this thought of hotel investing, and given the fact that it's cyclical and may not be um as super strong like a multifamily investment, that you would have to have this large down payment,
Mhm.
and it'd be tough for people to get into. But I know that you've leveraged partnership that has allowed you to get into opportunities that some of our listeners may be interested in,
Yeah.
but don't necessarily know like how to do that.
Yeah. No, that's a great question. I actually thought about this not too long ago, that um, relationships really helped me throughout my life. I've been fortunate enough to build relationships, to understand the importance of relationships. And relationships are transactional, right? Networking is transactional, and a lot of times, what people fail, they fail within relationships or business transactions, or networking, because they're with them. What's in it for me? They're not thinking about that other person, right? So I get DMs all the time about somebody pitching a deal to me. It's their deal, but they want me to work with them. And it's like, okay, I don't know you. It's not in my DM, which means probably don't have any money. You don't know what you're doing, and you're looking at me to do all the work. And then it's going to be a conversation over equity, and you're not going to give me that much because you found the deal, right? So that's what I mean by people fail, because they don't create a space where, okay, what's in it? It should be what's in it for both of us, right? So how can, if you can find something where both everybody walks away with the win-win and it's fair, and you do business the right way and you don't try to cheat anybody, then you're able to sustain and build those relationships. I have relationship that I've been knowing people since I was in college, and I can still pick up the phone and be like, hey, how you doing? You know what I mean? Those type of relationships you want to have, because the world is so small and you never know when that person's going to come back around, or when you're going to need that person is going to need you. Of course, I've had partnerships that failed, things that work out, that happen. It's a part of life, but it's how you walk away from that relationship and from that, from that experience, because again, you never know what's going to happen. It's some decisions that I could have made and it could have ended really badly, and I probably wouldn't be here talking to you today because I didn't end that relationship the best way. Like because the world is so small, and then I'm in Black hotel ownership. That world is even smaller, right? You know what I mean?
Yep. Mm-hmm.
So you want to preserve that relationship. You want to keep it going. And again, you don't want to just make it where it's all about, okay, what can I get from that person? Because nobody wants to be used, And so if somebody makes you feel like that they're being used, they're not going to want to work with you. And then the higher that a person gets in life, the more and more people ask them for stuff.
Yeah.
And so you have to be cognizant of that. When you're reaching out to people and you're constantly asking them for stuff, you're not the only person, And so it's like, okay, what makes your opportunity so special? Why would I want to work for you? And then again, what are you doing that's going to make me want to stop doing what I'm doing and take the time out of my day to actually talk to you? Right.
Yeah.
So those are the
No,
things
that's
about. Yeah.
I 100% agree. You always have to lead with value, especially when
Right.
people are out here doing deals and have a
Right.
business to run. And it's not easy to operate, hotels. It's not
Right.
easy to operate commercial real estate in general, unless
Right.
you're doing some sort of like net lease opportunity,
Right.
where
Right.
the tenant is handling everything. You
Right.
know, people have busy lives, and so if you lead with value and then
Yeah.
have the optimism that you are relationship driven and
Yeah.
that person can help you get to the
Yeah.
next level, I think
Yeah.
that's the best way to try to create a relationship and get a deal done, because you might have a deal but you still need the money, which is really the most important part, and you
Mhm.
also do need the operational expertise. And if you don't have those two, really the deal doesn't matter. You're just going to miss out on an opportunity. So I
Mhm.
love the way that you broke that down to really dive into like how to build relationships and the importance of creating value.
Mhm. Yeah. That's
So
the thing.
so how are you financing these acquisitions as well? Are you using like is it just, recourse debt? Are you using non-recourse debt? You know,
Yeah, we try to do non-recourse debt for the debt side, and then we bring in equity partners for the equity side.
yeah. And for our listeners who may not know what non-recourse debt is, can you talk a little bit about what that is?
That's not you having to personally guarantee the project. So those types of loans are harder to get, and you have to be really more of a sophisticated investor to get those deals. So basically, what that means is that you're using the building. If something happens, the bank wouldn't come after you. Of course, the bank doesn't like that. They want to get the building, and they want to come after you because they want to get their money back. So it's a lot harder to get non-recourse. But that's what we try to do, because really, and a lot of
Yeah.
people try to get non-recourse because nobody wants to be personally get responsible. They want them to come get the building and not them having to take any, be on the hook for it.
Yeah, yeah, and just to get your foot in the door, you have to have the net worth and liquidity requirements
Right.
to
And
get
that's
that
the big thing. And I
non-recourse.
don't know why people don't understand that. It's just like you have to have the net worth, the liquidity, and you always have the credit profile. So it's like, a lot of times people want to jump into these major deals and they don't want to put any risk. They want it to fall on to somebody else. And what you just said, net worth, liquidity, and I'm gonna add credit to that. So it's like, if you don't have any of those three, then what are you bringing to the table besides the deal that I can get from somebody else? You know what I
Yeah,
mean?
yeah. That's I totally agree. You really have to bring value to partnerships. That's how we always approach any sort of partnership. And
Right.
I also heard you talk about on a separate podcast platform about their potential SBA options that our
Right.
listeners may be able to acquire some of these hotels under.
Right. If you find a deal that's less than 5 million, there's an SBA 7A. Is it 7A? It's either 7A or 504. I always forget. But anyways, SBA, the Small Business Association, they have a loan program for commercial real estate asset classes, and the hotels are included, where depending on the deal, 10 to 20% down, and your credit profile, that you can qualify for an SBA loan up to 5 million. With those particular deals, you do have somebody on your team has to have hotel experience. So if somebody worked as a general manager or has some type of ownership stake and or investment stake in a different hotel, somebody on that team. So the three things that lenders look for and the three things that makes a hotel successful is the location, the brand, and the operator. You know, hotels are real estate. So what is the most important thing in real estate? Location, right? Brand. So does like 100. I know a lot of times people want to start their own brand, and I'm like, hey, there's like over 100 of them. We really don't need another one. But having a brand is important to the lenders because they know that it makes sense. They know that it works. Lenders are already skeptical lending out money anyway on hotels. So adding a non-branded hotel to the factor doesn't really help. But adding something like a Hilton, a Marriott, a Hyatt, or IHG flag choice of Wyndham, they've gotten their money back and then some on those brands. They know it works. They get it. They've stayed at them. You know what I mean? So it makes sense.
Yeah.
The operator is somebody who's managing the day-to-day operations. And that's probably one of the most crucial things because they're going to make sure that the hotel runs effectively and efficiently so that way the lender can get their money back. So going back to the SBA and other lenders, those are the things that you want to have in place prior to you speaking to them. Or kind of get an idea, at least having an operator, because that's what they're going to ask you. They're going to be like, who's going to, and the brands are going to ask you, like, who's going to operate the hotel? And you can't be like, oh, me, I just started. This is my first time. They're going to be like, okay, needed like a real strong general manager, or you have to take some type of program, or somebody's going to have to vouch for you that you'll be able to handle this operation.
Yeah, and I've heard too that there are application fees when you're dealing with a large brand.
Well, it's a franchise. So it's a franchise. A lot of people don't realize when you're buying into a hotel, you're buying into a franchise. And so what these franchises do, they have application fees and they have franchise fees associated with it. So yes, you do have to pay application fees. Depending on the type of brand, the application fees are more than others.
Yeah. I've heard it's in like the six figures for
some hotels are in the six figures. Some of them are, 4 figures. Some of them are 5 figures. It literally just depends on the deal. So again, when I tell people to start in the economy, again, that's a good way to start because the application fees may not be in a 6-figure range.
Yeah. Yeah, it's that's a pretty penny there. That's a lot of money.
If you don't get approved,
yeah, non-refundable.
Right.
That's a tough pill to swallow. So I want to talk about your crowdfunding platform and also how you kind of structuring these deals. Can you give us some context of both, how you're structuring these deals and maybe touch into the crowdfunding platform that you have for investors to invest with you as well?
Sure. So Vesterr, which launched on July 11th, my daddy's birthday, this year, it's a crowdfunding platform and it's for commercial real estate. And so essentially what you can do if you have a deal that you need to raise equity or get limited partners for, is your deal. Just think of us as a marketing platform. We're registered. We're a member of FINRA, so that means we're regulated. Go to vesterr.com, vesterr.com. You can upload your project to the site. We will vet it. To make sure it goes through compliance. If it gets approved, then we'll upload you to our website. Investors or limited partners or silent partners, they can come in. So think of it as a marketplace. So it's a marketplace of different deals, commercial real estate deals that they can look at and invest. If they decide to invest, meaning after they do their own due diligence and they decide to move forward, the investor will come in and they can invest using their, self-directed IRA, credit card, wire, ACH. And then the money will be going to an escrow account until the deal closes. And then the money will be transferred over to the sponsor. So that's Vesterr. And you can raise up to 500,000. You can raise up to 5 million. Per Reg CF rules. I didn't come up with that. There's something SEC came up with, which stands for Securities Exchange Commission. And then also what makes our platform unique is that both accredited and non-accredited investors can actually invest in the platform.
That's amazing. You've got to love real estate today, being able to at a click of a button invest in opportunities that really wasn't available, over 10 years ago, to the average person.
Right.
who had a lot of money in their 401k and just
Right.
invested in the stock market and dealt
Right.
with the roller coaster ride of the stock market. But here
Right.
you have, a real estate marketplace that allows you to invest in opportunities that can certainly, increase your wealth and give you a
Yep.
nice good return.
Mm-hmm.
So, talk a little bit about your book and your coaching sessions and how, if someone is interested in investing or becoming an investor in the hotel space, how they can learn from you and your journey.
So I have a book. It's called How to Buy a Hotel. It's on Amazon. And it just, talks about, the different types of hotels that I mentioned earlier in the show. It talks about how you can analyze a deal. I even have a virtual series where you can listen in and listen to different speakers. Like Mike Ely, my business partner, he'll walk you through how to analyze a deal, 20 minutes or less. We have different investors. They're first time investors, other owners. We even talk about how to invest in a REIT because there's 4 different ways that you can invest in a hotel. Real estate investment trust is one of them. So that's what's talked about in the book. I also have I'm out relaunching my mastermind program for the folks who really want that hands-on experience to kind of walk them through and navigate. These are for the folks who are looking to own a hotel probably within the next 12 to 24 months. Yep.
Yeah, that's great.
Yep.
It's always good to, I'm a part of a mastermind, and it's always great to learn from people who are doing the business because
Yeah.
either you can do it yourself and spend the money and
Right.
potentially lose money, or spend the money to learn from someone else and
Yeah.
accelerate that path
Yeah.
forward.
Yeah. And it's also the community too. I've seen so many people and so many friendships that were created just from, being a part of the community. So yeah,
Yeah,
great.
yeah. No, it's your
And deals
network.
done too. Deals done. People
Yeah,
find investors, people get on deals. It's just amazing the community that's just been created. So I love
yeah.
it.
That's the power of technology, just
Yep.
bringing people together.
Yep.
So let me ask you a question. This real estate stuff, it's a marathon. If you were to look back and, if you had something that you would change within your journey, your marathon, what would you do differently that you think would contribute to your success?
Started earlier. Mhm. I would have
Mm.
started earlier and I probably would have try to find a mentor. I wish all the information and content that's out now, I wish I would have been out there before. I probably would have had about 20 hotels in my portfolio, multifamily, daycare, senior living. I mean, who knows where I would have been um, if I would have started earlier and had a mentor that kind of walk me through it and kind of guide me. And then also being more focused and focused on the present. I think I would have been a lot further in life on my journey, my real estate journey.
It's always a good time to buy real estate, but the earlier that you start
Yeah,
off, it's
yeah,
such a incremental runway that you
yeah,
have if you can start early and as soon as possible. I mean, this business is there's a lot of ways to make money, and it's a lot of ways to create generational wealth. And if
yeah,
you just stick to it and
yeah,
just continue to push on a day-to-day basis,
yeah,
man, it's no ceilings to this business and your financial future.
yeah.
So if our listeners are interested in following you, investing with you, how can they follow you and get in touch with you and your company?
Sure. I'm on Instagram at Davonne Reaves, DAVONNE REAVES. My website is the Vonne Group, THEVONNEGROUP.com. So everything you need is there. I'm on Instagram and I'm on LinkedIn.
That's perfect.
Yeah.
Well, Davonne, thank you so much for being a guest on our show today. We talked a lot about
Yeah.
hotel investing,
Yeah.
how to invest, the yields on hotels today, different KPIs of what to look for when investing in a hotel, how to finance these properties. I mean, there was just a ton of information. So, if you're listening to today's show, definitely follow Davonne because she has a ton of knowledge in the hotel space. So thank you so much for being a guest on our show. Thank you to the listeners for tuning in to another episode of the Mogul Marathon Real Estate Podcast. Take action today. Let's be great. And remember that real estate is a marathon, not a sprint. Run
Yeah.
your own race.
Yeah.
Thanks again, Davonne.
Thank you, Yannick.